Let's do a quick check. If you make content online and brands started sending you free products or paying for posts, do you actually know if that counts as taxable income? Not a guess. Do you know for sure right now? If you hesitated, you are not alone. Making videos on your phone or recording a podcast in your bedroom simply doesn't feel like a traditional job with strict corporate rules. I recently spoke with a creator who didn't report a single dollar of brand income for her first 2 years. To her, gifted gear and sponsorships felt like a perk, something that existed entirely separate from the normal economy. Operating as if the creator economy follows its own set of informal rules means every brand deal and gifted product leaves behind a trail of unaccounted-for value. The IRS sees a ring light and a bedroom setup the same way it sees an office cubicle or a plumbing business. The moment money or something of meaningful value changes hands in exchange for your content, you are participating in the traditional tax system. We are going to look at the mechanics of how these obligations accumulate, often without a creator realizing they've even triggered a tax event. At what exact moment does posting videos you enjoy making legally transform into running a business? Take Casual Carlos. He started posting workout clips during his lunch breaks for fun. But within 18 months, Carlos was pulling in brand deals, getting a cut of ad revenue, and even selling his own merchandise. This timeline shows a legal threshold the IRS calls intent to profit. The second you genuinely try to make money from content, you cross that line. You are legally a business, no LLC needed. The obligations kick in the moment value flows toward you. There is no orientation day or HR department to explain these rules. Creators like Carlos often become self-employed without a single formal warning sign. Once you've crossed that line, we have to look at what actually counts as income. Direct cash sponsorships are the obvious starting point, but another category catches creators off guard. Those free products and services brands send you generally count as taxable income too. The IRS applies a fair market value rule. If a company ships you a $2,000 camera for a review, it's logged as $2,000 of taxable income. This list also includes affiliate commissions, platform ad revenue, and bartered exchanges, even with no cash involved. The tax code cares about the value you received. It does not wait for a physical deposit to show up in your bank account to consider it real earnings. This pile of creator income is subject to a specific tax that catches independent workers off guard, the self-employment tax. This chart shows the 15.3% tax for Social Security and Medicare. At a traditional job, you pay half and your employer covers the rest. But as a creator, you are both employee and employer. The entire 15.3% burden shifts entirely to you. Carlos owes the full 15.3% on his creator earnings, a tax obligation that exists entirely separate from the income tax he is used to paying. Right now, Carlos is operating as if he still has a fun hobby. He isn't setting money aside or tracking his expenses because he doesn't realize he's already a business owner. This lack of tracking builds a financial liability that stays hidden until tax season arrives and forces the issue. The IRS does not offer leniency because the rules were unclear. Not knowing your tax status provides no legal protection once the filing deadline passes. Transitioning your mindset from hobbyist to business owner is the first step in managing these requirements before they become unmanageable, which leads us to a decision. This transition, aimed at helping business owners manage their tax burden more efficiently. You have likely heard of the LLC, but to figure out if it is an actual solution for your creator business or just a misunderstood buzzword, we have to look at what it actually protects. Let's say a brand sends you a $2,000 professional camera lens in exchange for a quick review video. Do you know with absolute certainty, right now, whether that counts as taxable income? If you hesitated, you're in good company. When your income comes from ring lights and phone cameras instead of a corporate cubicle, it's easy to assume you're operating outside the normal financial rules. It doesn't feel like a traditional job, so it feels like the taxes shouldn't work like one either. But the IRS sees it differently. This timeline maps exactly how the government views your channel, with the hard boundary line right here, intent to profit. The moment you genuinely try to make money from your content, you are legally operating as a business. Take our example creator, Casual Carlos. He started posting workout clips on his lunch breaks just for fun, but over 18 months, his followers grew. He received his first ad check, and brands started sending him workout gear. Carlos never officially launched a company, but his channel landed firmly in the business zone anyway. You don't need to file for an LLC or hang up an official business license to trigger these tax obligations. The transition into self-employment is completely automatic. Because there is no HR department to explain the rules, creators operating informally quietly accumulate a massive tax liability. That debt grows silently in the background, month after month, until tax season arrives and forces the issue all at once. The confusion starts with how the IRS defines income. It extends far beyond the direct cash payments that actually show up in your checking account. The tax code operates on something called fair market value. If you receive a piece of equipment in exchange for a review, or even barter a shout-out for a service, that physical item transforms directly into a $2,000 taxable income entry on your ledger, valued at whatever it normally retails for. Failing to track the value of those physical items is an incredibly expensive error, and it hurts a creator's finances in two distinct directions at once. The first problem is underreporting. If you assume a gifted camera is just a free perk and it stays missing from your income report, you are holding on to undeclared taxable income. This creates a severe risk if your returns are ever audited. On the flip side, if you genuinely use that camera for your channel going forward, it qualifies as a business expense. If you never tracked its initial value, you miss out on claiming the depreciation to offset your larger tax bill. By ignoring gifted products, creators expose themselves to legal trouble for undeclared income on one end, while quietly overpaying the IRS by abandoning perfectly legal deductions on the other. To see why those deductions matter so much, look at this stacked bar chart showing the creator tax structure. Right on top of standard federal and state income tax, there is an additional 15.3% self-employment tax block specifically covering Social Security and Medicare. If you are a traditional W-2 employee, your employer automatically pays half of that obligation. But as a self-employed creator, you are both the employer and the employee. Those two halves merge, and you owe the full 15.3% entirely on your own. The primary way to reduce that heavy burden is through legitimate business deductions. Expenses like editing software subscriptions, specialized recording equipment, and a dedicated home studio space directly reduce the total income that this tax applies to. There are strict limits to this, particularly around clothing and makeup. A common myth in the creator space is that any outfit worn on camera is deductible. The IRS specifically prohibits deductions for clothing suitable for everyday use, regardless of whether it appears in your videos. Because the self-employment tax inevitably takes a massive slice of your revenue, identifying every valid deduction while steering clear of illegal gray areas is the only effective way to protect your actual take-home pay. When creators realize how much they owe, their first instinct is usually to ask if they should form an LLC to lower their taxes. The short answer is no, because an LLC does not automatically save you a single dollar in taxes. By default, the IRS taxes a single-member LLC exactly the same as an individual. Instead, an LLC is a legal protection tool. It acts as a solid barrier standing between your personal savings and business threats like broken brand contracts or lawsuits. Once Casual Carlos realized he was running an unprotected business with mounting tax debt, he didn't panic. Instead, he stabilized his finances by building a straightforward three-part system. First, he set up a spreadsheet tracking the fair market value of every payment and gifted item. Second, he opened a separate business bank account to keep his finances clean. And third, he started making quarterly estimated tax payments to the IRS to avoid underpayment penalties at the end of the year. He held off on the LLC paperwork until his channel grew substantially. He only established one when his brand partnerships became frequent enough that he actually needed a legal shield against potential liability. Long-term survival in the creator economy means treating your channel exactly like a traditional business. You can start building that infrastructure right now. Take 15 minutes today, open a spreadsheet, and log the fair market value of every piece of income and every physical gift you received last month.